Secrets to Abundant Living podcast community. Welcome to a very, very special episode. I am excited to share with you today a webinar we had with our investor club. Normally that is private. Our investor club is private. Our educational webinars are private, but this was just so good. I wanted to make sure to share with you. It's actually going to be a two-parter. And so I'm excited to share this with you. The title of the webinar is Volatility Insurance: How to Shield Your Wealth from Economic and Monetary Storms in 2026. And our special guest is Bruce Fraser with Elkhorn Capital Partners. If you don't know him, he's actually been my business partner on now 5 apartment complexes that we've purchased together with our investors. And let me tell you, Bruce is quite remarkable. I'm going to give you a little bit of his background here, and then we're going to bring you right into the presentation. It is something you are not going to want to miss. So Bruce Fraser is a former hedge fund manager who, after trading to all-time highs during the 08-09 financial crisis, directed his attention to building a portfolio of hard assets. He has been a full-time entrepreneur and investor fiduciary since 2000, overseeing the management of $2 billion in investor assets. He's overseen over 100 real estate transactions for partners as well. His prior experience spans hard money lending, ITIN, borrower note organizations, and tax lien acquisitions. He is a disciplined, quantitative investor that successfully utilizes macroeconomic indicators that are the basis for proven top-down investment approach. And let me tell you, he's got the track record to prove it. After having been heavily invested in real estate until late 2007, he liquidated all of his partnership's real estate holdings based upon the severe divergence of macroeconomic indicator imbalances. He began re-entering the market in 2010, and results have been extremely compelling. Elkhorn Capital Partners specializes in distressed situation multifamily acquisition, and the firm has surpassed over $300 million in income-producing multifamily assets. So Bruce Fraser is the managing partner of Elkhorn Capital Partners, and I'm so excited to show you all the information that he and I both shared, that without a doubt, this education, and that's all it is, this is just for educational purposes, will serve you and your investment portfolio here in 2026. All right, here's the webinar. Enjoy. Everyone, welcome. We're really excited to have you here today. It is no secret that 2026, the macroeconomic landscape is changing and ever evolving. And our job and what we're excited to do is really talk you through some of the data that we're looking at. And obviously, we've got an incredible person here, Mr. Bruce Fraser with Elkhorn Capital Partners, who's joining us. And for those who don't know me, my name is Amy Sylvis. I'm the founder and CEO of Sylvis Capital. We connect investors to hands-off real estate investment opportunities. We now have 20 apartment complexes and flex industrial, 5 of which are actually partnerships with Bruce and Elkhorn Capital Partners in Oklahoma City and Tulsa. Bruce, we're really excited to have you here today. Thank you again.
Great to be here. Great to be here. It's, my whole team, we talk about macro environment a lot, trying to figure out where things are headed. So we try to get on the right side of it. We've been very successful at doing that in the past, and hopefully we get it right this time too, looking forward.
Well, I would love, for those who don't follow you on LinkedIn, I'm actually going to put that link in the chat, but you have such a great handle on this macroeconomic environment when, we're looking at tariffs, we're looking at the national debt, interest rates, a new Fed chair. There are so many moving parts. And I'd love to just kick this off from kind of a top-down approach, because all of us here are investors as well, but we can't invest outside of the macroeconomic context. So it'd be great to kind of understand what you're thinking through in terms of the headlines or what you're seeing here in 2026.
Well, you cannot invest outside of it. You'll just lose money.
Yeah, not successfully. Thank you. Correct.
Most people don't pay attention to the most important thing, which I think is the macro. And I had that discussion with some investors at a real estate conference, probably, I don't know, maybe 7, 10 years ago, and
Mm.
everybody's talking about where we were in the real estate cycle at the time. They're all like, "Oh, we're late stage," and like honestly, where we are in the real estate cycle at that point in time, I said probably doesn't even matter. What matters is what's going on with the currency and the debasement of the currency. So we subsequently look back at that, and we made millions of dollars after that in real estate. And there's so many people on the sidelines because we thought we were late stage. But yeah, anyway, so headlines, gosh, so complicated of an outlook right now. It's
Mm.
very, very uncertain. We've got a new administration making moves that, weren't on your bingo card the day before. Like, they're making very large changes and doing things that you didn't think was kind of an option. And so, Venezuela is a great example. Politically, I'm not going to touch that, but strategically, very smart to do. They've got they're one of the most resource rich countries in the world. And if you look back pre-Vietnam, wars were about resources. You would
Right.
take over countries to take their stuff. And then we got in this PC world where we fight wars for other people and go into massive debt and we don't take their stuff. And so we end up, insolvent. But so Venezuela was not about narcos. I mean, that's just kind of a headline and, a bonus. If you were really going after the narcos, you'd go into Colombia, right? Or Mexico. Um, but it gives cover, and now we control one of the world's largest reserves of oil,
Mm.
and another, not to be political, but because it rubs some people the wrong way, but it's smart. We depleted our strategic petroleum reserve to try to, under the Biden administration, trying to reduce oil prices, which makes sense if you're trying to fight inflation because oil is one of the number one inputs to it.
Right.
But they never replenished it when it went below 70, like they said they were going to, and so left us in a militarily strategic bad position. And Trump just said, "Hey, first thing we're doing, we're going to refill the SPR, and we're not paying for it." Guess what? It's like, okay, smart, but
Yeah.
you know, not usually something you say openly. So things are unpredictable for sure, but there are some things that are pretty clear. You and I talk a lot about the U.S. government debt, what's going on, and it's honestly not just the U.S. It is basically the entire fiat system, which, on the whole world stage. But, we are math people, we are quants, and we try to think through everything based on the numbers and what it's telling us. We try not to be emotional about it. But if you look at the numbers, the debt can't be repaid, not in today's value dollars.
Mhm.
And so it's just not possible. They could do wealth taxes or whatever else they could dream up. There you go. Look at the rate of change of that graph. It's hard to even put up anywhere now. It's just crazy.
It's
Uh,
hard to
but that
digest.
is the annual U.S. government debt, and it's growing at over 10% a year on a big number. The kind of the rules of math are that as the number gets bigger, usually the growth rate slows because the incremental is a lower percent of the overall. But that's not what's happening. It's actually spiraling now, and it appears to be growing faster and faster. And so that's a problem because you have to have buyers for all that debt.
Right.
And so who's big enough to buy it? Well, central banks. They're really the only ones that matter. And we stepped on kind of a bit of a landmine where it seemed like the right thing to do, I guess, if you didn't think through it fully. But in February of 2022, the US did, quote, sanctions on Russia. We didn't want to get in a hot war with them. So we did something financial to them. And for those that don't know, central banks, of course, they keep reserves of currency, and that's usually, it's not actually in stacks of cash. It's in the treasuries or debt securities of the associated country. And so back in prior to World War II, countries, central banks on average kept 80 to 90% of their reserves in gold. And just after World War II, the US was kind of the biggest, baddest on the block. We just saved the world. We also had 2/3 of the physical precious metals holdings in the world. And so it made sense to make the US dollar the formative base of the monetary system that was being reformed. And so it became the world reserve currency. People started using it for the reserves. After 71, we went off the gold standard and things kind of went to shit after a lot, excuse my language. But so there was no constraint at that point on how much we spent because people had to use our dollars and in world trade at that point. So fast forward to today, the percent that people or central banks kept in gold got down to right at 10%. And the rest was in dollars and other things, but mainly dollars. And so 2022, we basically just, they say froze, but we took Russia's reserves. And depending where you source your numbers, that's anywhere just under 400 billion to a trillion, depending which accounts you include in it. But a lot of money, a lot of money. And it was a line that had never been crossed before in the world. And when that line was crossed, people thought either there wasn't any counterparty risk, and all of a sudden they woke up and said, gosh, our entire net worth of our country has major counterparty risk to the political whims of this other country.
Wow.
If you're Brazil or Chile or France or Germany, you look at Russia and you say, you know what? They're one of the big boys on the block. They've got hypersonics. US doesn't even have hypersonics yet. They've got nukes, and they just stole 400 to a trillion dollars, 400 billion to a trillion dollars of theirs. What will they do to me? And so, so everybody all of a sudden felt that risk. And so the obvious outcome of that was, what did they start doing? They started becoming net sellers of treasuries and adding gold. And so that's why there's just this continuous bid for gold right now, no matter where the price is, because if you're running a central bank, you tell your team, you say, we're at 10%, take it to X percent, whatever that is, 60%. Are we going to go back to 90? I don't know, but it's something higher than 25 to 30 where we are now. And so, we've gone from 10% to 25 to 30% in a very short order. And so, the central bank buying has moved from what was roughly 17 metric tons to, they're forecasting, I think it's 76 metric tons today. And so complete paradigm shift. And I don't think you can put that genie back in the bottle. And so you can't say, oh, no, we won't do it to anybody else. Nobody, you've breached the trust of the world. And so that's a trend that's going to continue. And so what does that mean for us as investors though, right? And so, well, that means fewer buyers of the debt, more debt needing to be issued. Somebody's got to buy it. And, your biggest buyers that matter aren't buying it. And so that means that the nice term for it's quantitative easing, but what it means is we print our own money, not physically, but electronically. We create new money out of the air to buy the debt securities ourselves. And they just restarted this in January, 40 billion. And they said to anticipate that level per month going forward for the foreseeable future. Well, I promise you the number's going to get higher, but that's kind of where things are right now. So I've talked a lot. I'll let you go.
Have you ever thought about having multiple streams of income? Instead of relying on just one stream of income where you're trading your time for money, how would you like to free up more of your time and live a more abundant life? As a listener of the show, you're invited to attend one of our upcoming trainings where I'll give you an inside look into how you can add passive income and get all the other perks of recession-resistant real estate investing without the headaches of being a landlord. I'll also be sharing some hidden mistakes to avoid and the criteria I personally look for when evaluating potential investment opportunities. To reserve your seat for free, go to sylviscapital.com/webinar. Again, that special link to reserve your seat for free is sylviscapital.com/webinar. I look forward to seeing you on the training. And now back to the show. No, this is fantastic.
But the graph that you just put out, it's a graph that I created just to kind of monitor the growth rate. And you can see we hit the debt ceiling at least once a year. I mean, the debt ceiling was originally created to be a constraint on spending. It wasn't put in place to create a political negotiating lever every year, just to raise it again. And so, there's all this hand wringing every year. It's probably going to be, more frequent than every year now with things increasing. But all this hand wringing over whether they're going to increase the debt ceiling and what's going to happen. Of course, they're going to increase the debt ceiling because otherwise we default. And so, they've done it, I think, close to 100 times now over history. And so we hit the debt ceiling. But when you hear that, the funny thing is, it doesn't mean that they stop spending the money.
Right.
They just stop paying bills, right? They just stop paying bills for a period of time. And so then when the debt ceilings increase, there are all these stacks of bills that have to be paid. And so, the debt spikes up again immediately. And so, it doesn't level off. If you see, what was that back in 22, about when we hit the debt ceiling, flat for a period of time while, politicians were trying to negotiate with each other and get a bunch of, bridges to nowhere tucked into the spending bill. And then it, goes up, but it doesn't ever level off. It just keeps going up until it hits the next debt ceiling that was reset. And, we're in a period now where, that's happening again. But that is recent history. Further back than this, we were averaging a growth rate, like I said, just over 10%. But on the most recent period on that post debt ceiling graph, it's closer to 15% annualized. 15% on $38 trillion is a big number. And, we're adding a trillion in debt roughly every 90 days. And that's with current spending levels. And so
Right.
a trillion is hard to even conceive how much that is. I won't go into it here, but Google how that differs from a billion. It's shocking how different it is from $1 billion. It's more debt than anybody's ever had in the world. And so, how do they solve it? And you and I have talked about this a lot, but there are a few ways you can solve it in theory.
Yeah.
You could raise taxes, which is always the popular thing for people to talk about. And what politicians often forget, and we're seeing it, we've seen this happen over and over, but in your home state of California, they're proposing, they haven't even put it in yet, but a wealth tax.
Ugh.
Well, you know what? Money is fungible and transportable now. So what ended up happening? All the famous billionaires that moved their entities to either Florida or Texas
Correct.
for legal status to try to get out of the way. Well, now they said it's going to be retroactive, but you know what? They're like, you've shown your stripes. It's kind of like us doing the sanctions. Like, if you're thinking about it now, it's going to probably happen at some point. So I'm out. And
Yes.
I'm going to take my toys and go to a different sandbox. So, but if you do the math on it, raising taxes can't solve the debt problem. It couldn't even solve our current 1-year deficit problem. And so that's not a solution. Cutting expenses, Doge, Doge, a lot of people are really optimistic about it, and all these geniuses trying to solve this, just quagmire of, waste and fraud. And
Mhm.
there was so much pushback against it. And I've heard Musk interviewed about it. He's like, listen, we won't name names, but he said 90% of the fraud is on one side of the aisle, but there's still about 10% on the other side of the aisle. And so there's not enough support to get any of these cuts approved. And so he
Correct.
just kind of washed his hands of it and left, and he was really excited about trying to help the country. And, on a Rogan interview with him, he's like, well, how much do you think you could have cut? He said, well, what kind of powers do I have? And, they're video game guys. And he's like, godlike powers.
Yeah.
And he's like, oh gosh, with godlike powers, I could cut more than half of the spending. But it wouldn't politically, there's so much grift that they don't want those programs cut. So that, I'm not optimistic about expenses solving the problem. Default, they're not going to explicitly default. Every time in history we've ever looked, they have the choice of saving the currency or protecting the debt, because the debt allows for all the spending. They always sacrifice the currency,
Mhm.
always, every time. And so, they're not going to explicitly default. They'll just take the fourth option, which is inflation. And so they'll print money. There'll be high and sustained inflation. They'll continue to change the CPI calculations, but it's not fully reflected. But you and I, as consumers, will be spending a lot more than a 3% increase, on inflation. Even at 3%, people go, oh, inflation's gone down. Well, the rate of growth of inflation has declined in theory. And part of that is them changing the calculation again a couple years ago. But if it went up 100% and then went up another 3%, well, you know what? You don't feel any better. It's still worse. And
Right.
so, a couple years ago when CPI printed 9%, the funny thing is, if you kind of look under the hood, how is that comprised? Well, right at a third of it is tied to what they call owner's equivalent rent, which is just a Frankenstein number that they've changed over the years to try to represent what housing costs is without showing much inflation. But CPI, which is a third of it, was showing a 3% increase. And this was a period of time where housing prices had doubled, and rents had certainly gone up, you and I both know,
Yes.
and double digits. And so, it's just an absurdly long number. But even 9%, people were getting really upset, even though because they felt like it was even more. But so the game here is to have high and sustained inflation and not show it, and try to keep it probably mid to upper single digits so the peasants don't riot, and get angry. But, this is the fifth one, is one that was, really not on my list previously, and that's to grow your way out of debt. And
Mm.
so Bessent, head of the Treasury, very smart guy.
Yes.
When they saw Doge kind of fail, like, okay, well, the only other choice is to grow GDP faster than we're growing the debt. Well, that's great, but if debt's growing at over 10% a year, how often has it been that we have grown the GDP at greater than 10% per year on a sustained basis? Never, because we wouldn't need that for 1 year. We would need it for decades to grow our way out.
Right.
So we did have it print for 1 or 2 years above that level, but it both times related to World War II. The one was all the industrial buildup of, they were building tanks and all these things
Mhm.
prior to World War II, or while it was going on. And then coming out of World War II, it was just, the biggest economic expansion in our country's history. And so, even if we replicated the biggest economic expansion in the country's history, which now we're a much bigger country, so those are much bigger numbers and harder to achieve, they only got 1 year of growth at that level.
Right.
So what's the probability that we're going to have decades at over 10%? Zero, near zero. And so, it's not going to solve the problem. Could it slow or give us a little bit more time to kick or road to kick the can down? Yeah, it would help us kick the can a little bit longer. But what's kind of really concerning is both the current president, as well as the head of the Treasury, as well as the incoming potential replacement of the Fed head. They've all talked about a monetary reset needed in the country, and that
Yeah.
Besant himself has said how he wants to be participating in that himself. So within the next 2 to 3 years, under the current administration, they are planning for and want a monetary reset. And they referenced the Versailles Accord. They referenced a couple different historic times that had happened. And each time, what was the outcropping of that? And that was basically a major devaluation of the dollar.
Right.
Trump has been very open on his comments publicly. When the dollar was having worst year-to-date performance in history over the last month or so, he was interviewed about, or he was asked about it and on camera, and he said, "Oh, I'm not worried about it. The dollar's not weak." And so, we hadn't hit concern levels, and he's been very public that he wants a weaker dollar so that it can help our our position in global trade, so we can bring manufacturing back, and our goods and services aren't so expensive for foreigners to buy. That's a multi-decade move. Yes, we do need to bring some manufacturing back. I agree with that, because COVID, I think, showed that we were in a very difficult, tenuous position since China made most of our medical supplies and pharmaceuticals. And so, we had to get everything from them if they were willing to send it to us. And
Right.
so that's not a good position to be in. And, China's been very advanced in their technology. And so, terrifyingly, we buy a lot of our input products that go into our high tech weapons from China. It's absurd. And
Oops.
so,
Yeah.
again, not a good position to be in, but very hard to turn that tide quickly. But at least they're focused on it. So,
Yeah. Bruce, real quick, I have heard recently folks talking about using or mark to market the gold reserves that the United States has, which I thought was a really interesting strategy. For those who don't know, at least on the government's books, gold is valued at $42 an ounce. And if you're following gold, it's $5,000 an ounce, according to the market. I was doing a little bit of research myself over the past few days, and even mark to market, I'm not saying the strategy would even work, but if we were to do that, the valuation that our government has of gold on the books would only be a little bit north of $1 trillion compared to our $38 trillion of national debt and growing. So it's so hard to wrap our minds around how monstrous this debt animal is. But I thought that was interesting.
yeah. And, I feel like it should be certainly more representative of the current value than where it is. But yeah, this is just a financial magician kind of thing to
Correct.
do, where you reset it to, there's no constraint to say they reset it to current values. They could reset it to 15,000 or something
Correct.
like that, and just radically debase the currency. But it would show on paper, accounting wise, that the government had all this additional money and allow them to put a lot of cash, because the treasury would buy it from the Fed or vice versa. I can't remember which way it goes,
Yeah.
but it increased their checking account, so to speak. But it's, again, like you said, I've seen estimates all over, because the gold has been all over the place. But
Yes.
let's call it $1 trillion. I know that's close, and that's not even a third of our deficit for this current year, right? So, and you have to remember, Trump just tweeted or said the other day, our defense spending is around $1 trillion. He said it needs to be 1.5 trillion. Well, $500 billion is a lot of money, a lot of money.
Yeah, just incredible. I love that you bring up you and I were talking about our national defense, and I think it's very sobering to see our annual expenses as a country. This was just fiscal year 2025. The interest on the national debt was our third largest expense. I know Sam said, tongue in cheek in the comments, oh, we can just kind of ignore this national debt. I think interest on this debt is going to continue to grow, and I don't know if we're going
Yeah,
to be able to ignore it much longer.
that's trailing 12, right?
Mhm.
And, if you look at our current spending on debt and annualize it going forward, that's more like 1.2 already.
Mhm.
And we have 48 trillion in debt maturing over the next 4 years.
Yes.
So, no, wait, or is it 48? Yeah,
So-
this,
Yeah.
yeah. So,
just-
no, I think that's a little bit high. I think it's 28. I'm sorry. Yeah. So it's 28 trillion maturing in the next 4 years.
Mhm.
And so if you do some simple math on that, for, divided by 4, that's, roughly 7. trillion or six to 7 trillion, depending if you're using 24 or 28, but per year. Now it's not evenly spread like that, but so, if we look at COVID and what happened inflation wise, how much did we print during COVID? Well, it was less than 4 trillion. And so if we bump that up to 6 and then do it 4 years in a row, what's going to happen? And the reason I say that's money printing is because, again, there aren't enough buyers for that. And all of those are as your bullet point states, the current debt is at 0.5% to 1.5%. And, it's going to reset at probably 4 to 4.5. And so radically increasing your interest expense burn. And I said there are some really smart analysts out there that call, a real interest expense includes not just the debt service, but also the entitlement payments that everybody knows they won't cut. And so if you look at those two things together, Social Security interest on the debt, et cetera, then that amount is equal to almost 100% of the revenue collections by the Treasury. And so income taxes. And so that doesn't include defense. That doesn't include anything else, the Department of Labor, anything. And so just that amount is already 100% of what we collect. And that's not healthy and that's not sustainable.
Okay. Thank you for joining us for part 1 of our webinar. I know you've enjoyed it so far. Make sure to tune in next week to not miss out on part 2 of Volatility Insurance, how to shield your wealth from economic and monetary storms in 2026. We look forward to seeing you then.
Thank you for joining us on another episode of the Secrets to Abundant Living podcast. We hope you found inspiration and valuable insights that will empower you on your journey towards abundance. If you enjoyed today's episode, don't forget to subscribe, rate, and leave a review. Your feedback means the world to us, and it helps others discover the secrets to an abundant life too. Stay connected with us on LinkedIn, Amy Sylvis. Keep striving for your goals, nurturing your relationships, and embracing the adventure that is life. Until next time, we wish you an abundantly fulfilling day.